Hello, my name is Jim Cunningham, and thank you for watching How Does Your Financial Advisor Make Money? Know what you're paying for. I have with me Christina Lindsay, and she is a certified financial advisor with Ascent Wealth Management. And I'm Jim Cunningham. I'm an attorney. I've been an attorney over 25 years. I'm a certified specialist in estate planning, trust, and probate law. And so what we're going to cover today is essentially the people that handle your money. How do they get paid, right? I mean, I think it's a legitimate question. So before we get started, there is a disclosure. This is not tax advice, okay? It's not legal advice. It's not financial advisory advice. It's not advice, okay? This is information only. So it's really important to understand that there's no attorney-client relationship. There's no financial advisor-client relationship. But going forward, this whole thing is about information and education. Go ahead, if you're watching this on YouTube, subscribe on our YouTube channel. If you're watching this live, we encourage you to subscribe on our YouTube channel as well. And if you are watching this live, you can put your questions in the Q&A, and we'll hopefully be getting those to those with our time here together. So, Christina, what do you want to talk about? Let's talk about this.
Yeah, so we get a lot of questions. I know you and I have spoke about this many times, and there are so many different ways that advisors get compensated, and there's different ways that they can charge. And some advisors have a lot of flexibility in that, and some don't. Depends on if they're an independent advisor or if they're employed as a wirehouse advisor. And so we're going to talk about that a little bit. But there are essentially three main compensation models. And so what we're going to talk about is not only compensation models to the advisor, but fee considerations, mutual fund fees, whether it be insurance fees. So we're going to talk about efficiency strategies as well. And is it the most tax efficient way to get billed as a client? If you're a business owner, if you have an irrevocable trust or a charitable trust, there are certain tax deductible fees and certain ones that are not. In 2020, under the Secure Act, it was in the Tax Cuts and Jobs Act, when the tax laws changed in 2019, investment advisory fees became no longer tax deductible. So there are certain ways to charge fees that are tax deductible. And typically, wirehouse advisors are not capable of doing that due to the constraints of their employers. Independent advisors are. So let's kind of get into a little bit more of the meat. These are probably the most common different types of advisor compensation. There are commission-only advisors. That's it's funny when you talk about the old way of referring to an advisor, and you're not an advisor if you're particularly commission only. So you actually can't use the word advisor. You can no longer, it's illegal now to use the word advisor if you don't have an advisor license, a registered investment advisory license. So if you don't have your Series 65 or 66, it's technically legal to use the word advisor. So a commission only is typically a broker, and it's back in the day, you used to always refer to a stockbroker. So a stockbroker is exactly that. They're a stockbroker. They broker commissions for selling particular stocks, and they make a commission every single time they trade a stock or a bond. So you hear people sometimes refer to as churning. And churning is illegal, but there are some stockbrokers that do trade more frequently than others because they're commission oriented. So there are some things that are not necessarily a good thing when it comes to a commission, and that would typically be if you do have high turnover. Commission only is typically not the most advantageous for the client. Now, some things do make sense to be commission oriented. And so commission only means that they are truly commission only. There is no other way for them to charge. They don't have a 65 or 66 license, or they just purely do not charge anything on a fee basis. So let's just highlight commission only for a moment. Commission only means they don't do any other way of billing. Now, commission, having the flexibility to charge certain things, an independent advisor can have the flexibility of charging certain things on a commission basis and certain things on a fee basis. commissions are not always bad. And I use the example of a municipal bond portfolio. In our office, we manage 100 million or so in municipal bonds, tax-free, insured California tax-free municipal bonds. Typically, those are going to be designed for a client as a piece of their portfolio, as a bond ladder. So it might be something that we aren't going to touch that bond or replace it for 5, 6, 7, 8 years. And so rather than charging an ongoing fee for something that's really going to be held for a long period of time, it makes sense to charge things on a commission for the client. It's more cost effective for the client. And so the most important thing, again, is fee transparency.
Yeah, Christina, when I think of commission only, I think of, around the time of the American Revolution on Wall Street, when there was a wall on Wall Street and they would trade stocks under the buttonwood tree. That's what we're talking about. It's a commission. Like, I'll sell these stocks and you pay me a 5% commission or whatever it is. And when I started practicing law 27 years ago, a friend of mine's father had been was a stockbroker, but he was one of the old guys, right? And so he says, "Oh, I remember back in the day, this is downtown Ventura. Who did Morgan Stanley take over? Dean Witter. When it was Dean Witter, right? When it was Dean Witter, they literally they would write the prices up in chalk on a board. Mm-hmm. And then they would get on the phone and call their client and say, "Oh, this one's up, but why don't you sell that and buy something else?" So that is kind of gone, isn't it? I mean, really,
it's not. Unfortunately, it's not. There are still a lot of sectors that are commission only. So again, there's a distinction between commission and commission only. So anyways, commission only is probably, if they're commission only, you're probably not in the right spot, I would say, for today's era. There is fee-based. And so fee-based can be a hybrid model. So you could have a fee-based means it's a fee assessed to the assets under advisory. So that would be you're working with a registered investment advisor. They may be independent, they may not, but you're in a fee account that there's a fee assessed to the account. So if there's $1 million IRA, there may be a 1%. The typical round between 1 and 1.5 is about industry average, depending on account size. Typically, there's tiers based on account size, but a fee-based means you have a $1 million IRA and a 1% per annum fee charged to that IRA. And as the account goes up in value, the advisor is getting paid more. As it goes down in value, the advisor is getting paid less. So there's an incented correlation there. Some fee-based advisors can do also commissionable. So, there could be some things that are charged on a commissionable basis and some things charged on a fee basis. And then there's fee only. There is a difference between fee only and flat fees. And so fee only truly means that advisor doesn't receive a commission for anything. If they were to do any kind of other insurance product, that they're doing it on a fee basis, they're not, and it's not tied to account value. It could be, hey, you're getting billed a $10,000 $12,000 annual fee billed quarterly, or it's just a flat fee. It could be billed to the account, but it's a flat fee, and they don't do anything other than flat fees. That's not always necessarily a good thing. Sometimes clients go, "Are you fee only?" Well, sometimes it's good to have flexibility in your advisor to be independent, to say, this may be better for you to pay a one-time commission because you're a buy and hold investor. You have a long-term horizon. There's not a lot of active management. I go back to the municipal bonds. Something you're going to hold for 8 years. Do you think that should have an ongoing fee? Probably not. So fee only can be good, can be bad. I'd say that, most advisors that are independent, that are in the hybrid area, that have the flexibility to do what is in the best interest of the client is typically where we want to be. So there is a difference between fee only and flat fee. You can easily have an advisor that charges a flat fee. This is our annual rate. We're going to bill it to XYZ account, or we're going to bill it to your business, so it's tax deductible. However that might be, there could be fee and commission and different versions of accounts there is a difference between flat fee and fee only. Salary plus bonus. So many of I refer back to kind of the wirehouse advisors. Those are advisors that are employee advisors. They're not business owners. They're not independent. They are an employee of a major firm. And the wirehouse is where that term came from, is back when you used to send the trade over the wire. You used to tap the trade and send the trade over the wire. And so those are typically your big banks, your Wells Fargo, your Fidelity, your Charles Schwab, your Edward Jones. So those are like the big firms. Most of those advisors are going to be some form of salary plus a bonus or a commission. And they might charge certain things on a fee basis, but they typically are going to have some sort of a bonus structure because they're incented as an employee of the firm.
So let me ask you a question, Christina. Let's say hypothetically, I happen to be 52, but let's just say I'm 60. Poof, fast forward however many years. I've got $1 million in an IRA that I've rolled over. I've separated from the company. I'm not working anymore. I've got $1 million in savings, and I own my house and it's paid off. And what would be a good, should I go to a commission only? Should I go to a fee only? Should I go to a salary plus bonus? What do you see are some options and some recommendations?
So if you have an IRA, most of that's typically going to be fee based or flat fee. So typically an IRA, being it's a tax deferred or a tax free asset, depending on if it's a Roth or if it's a tax deferred 401k and it goes over to a traditional IRA.
Right.
I think we've talked about this, that eighth wonder of the world being compound interest. And you want your compound interest to be your highest growth returns, typically to be in the most tax efficient vehicle, which is most often the IRA. So there's often going to be more tactical management of assets, typically more growth oriented, whether it be stocks and ETFs or mutual funds. Those typically are going to be best suited in an IRA. Therefore, because it requires more tactical management, those are typically going to be fee based.
And then on the stuff that's outside of the IRA, I've got $1 million. Let's say I have $1 million in cash, and I say, I'd like to invest this and get some return on it. Does it make sense to? We're not talking. Does it make sense to buy stocks? Does it make sense to buy bonds? Does it make sense to buy an annuity? What do I do with that $1 million that's just in my name?
And that's going to be where it really depends on having a comprehensive, holistic advisor that is certified to you really need a certified financial planner that understands all aspects of financial planning, estate tax planning, insurance planning, long-term care planning, business planning, retirement plan. Going from accumulation of wealth to distribution of wealth is a completely different stage of life. So it depends on really what your overall financial planning needs are. And if you don't have someone looking at all of that and they're narrowly focused on just making recommendations on an account, when they don't really have a wider lens as to what your needs are, what your family makeup is, and what your income tax situation is based on the state you live in, you're not getting holistic advice.
And
so
you tend to get that from the independent advisors, just I would say as a broad category versus the salary plus a bonus. So if my advisor, let's say I'm at a national company, not to name any names, but let's say I'm at a national company, I call 1-800 blah, blah, blah to call them. Do they give me comparable services at a lower price is what I'm getting at, or not? Or is it that's not even going to happen?
Typically not. What we should probably go through is probably some of the next couple slides. I think we'll address some of these questions, but we kind of spoke to this a little bit, but assets under management, that would typically be a fee-based fee to where you're getting assessed a fee based on the assets that are being managed. And again, that can also be a flat fee based on the size of the portfolio. The hourly financial planning or consulting fees. So sometimes an advisor might say, you're in your accumulation of wealth, you maybe don't have a lot of assets there yet to charge necessarily an asset-based fee, but you do need a lot of planning. You need a lot of business planning or whatever, or you need a lot of tax planning. So those things are typically done on an hourly basis or a consulting flat fee basis, to where it's kind of a one-time engagement or a ongoing annual engagement. A retainer can also be that. So that could be a percentage of assets that are being managed, or it could be that there's an ongoing tax planning or consulting need. So that could be a retainer-based fee. And then again, a flat fee could just be, very a narrow scope engagement. Typically, when you have a flat fee, there's a scope of engagement that we're charging you a flat fee for these services. And then there are some that do performance-based fees. Those are typically when you're dealing with higher risk, higher octane, active trading accounts that you're looking for aggressive or, fairly aggressive returns, that there could be a performance-based fee. So those are probably less common. And then if we kind of get into the next sector would be commissions, highlighting what, typically what do you see commissions on? And we mentioned if you're a broker, you could get paid per trade. We're buying this many shares of Apple, this many shares of Microsoft. We're going to assess a 1% fee of the trade. We're going to charge a commission on the trade. Then you have insurance and annuity commissions. And none of these necessarily are bad. So I want to highlight that this doesn't mean wrong or bad. There is a time, there is a place for commissions. Where I take a pause and I say a significant pause is when you have an advisor or a broker that is purely an employee insurance broker that works for an insurance company, and I have to pick on them, and I'm sorry, but I have to. And it's, the big insurance companies, they only sell what makes them money. So there is a bias, there is a limited scope there as to, they are limited on what products they can offer on their shelf space because they're an employee of XYZ insurance company. And when you have someone that's giving you advice that's limited in what they can offer, I would say that is where you have to take pause. So if you have an independent advisor or a very holistic advisor that is able to look at all of the insurance products that are out there in the industry, if you have a long-term care need, if you have a life insurance need and you need to make sure that you've got proper life insurance coverage. If you need an annuity for income in retirement because you don't have a pension and you need guaranteed income, you may need one of those products that are best suited oftentimes to be done on a commissionable basis.
So let me help unpack what commission means.
Mhm.
Commission means that if a person does $1 million annuity with a person who is selling an annuity, that person's licensed, securities licensed, depending on the annuity, could be securities or insurance licensed, and then they're getting a commission. So they're getting a percentage of that amount that's invested. And maybe can you walk through, what I've seen is I'll see somebody, they'll have $1 million. They go to a person who sells annuities, and they get 5 annuities from 5 different companies for $200,000 each, versus essentially the same type of annuity with the same company. Maybe explain the difference in commission there.
Oh, and that can vary so much. It could be that there wasn't a person that was a financial advisor quarterbacking the solution as to why we're using this annuity versus this annuity. And that's probably where I would, again, take the most pause, is if you don't have one financial planner that's quarterbacking your plan, that's integrating all of these pieces, that's where clients can really get hurt. And I think that happens. Sometimes it happens a lot with teachers. They get taken advantage of. We see that a lot, to where they are limited in their 403Bs as to what services and investment options they have. And oftentimes they are probably the ones that are preyed upon the most by insurance brokers, because they make good commissions and they might buy this annuity for future income, and they get sold on the guarantee. And yes, it's a guarantee, but teachers have great pensions. They're probably the ones that need the guarantee the least. They probably need more liquidity in their portfolio of other savings. And so, I'd say that if you have standalone insurance annuities and products that don't have a certified financial planner looking at all of them to see which one might be for growth. One might be, hey, we're going to let this grow and defer for 10 years and you're not going to take income from it. And we're going to use this one to take income from now. So if there's a specific role that each annuity plays, that makes sense. But if you have annuity diversification just for the sake of diversification, or you got sold one from one insurance broker and another insurance broker, that's where you have problems. And you really need to review those to see if they should be improved upon.
And the other thing too is the way advisors are paid is,
Yeah.
you can game the system or not. And if advisors put annuities with different companies, they don't hit those break points. And what that means is if you sell a single annuity for 200,000 or a single annuity for $1 million, the $1 million commission is not 5 times the $200,000 commission. It basically what the advisor makes goes down the larger the transaction is the bottom line. And so that's something I've seen a little bit of abuse in. It's not too frequent, but you do see it. It's not something that's never seen, but it's not particularly common, thank goodness.
And I focus on certified financial planner a lot. And part of that is because a certified financial planner is a fiduciary. Not only are they a fiduciary, but they're held to a higher fiduciary standard than some just registered investment advisors. So under the Department of Labor Act and the best interest contracts, you've heard a lot of fiduciary. And so there was, all of this effort to make people fiduciaries, which means that you have to act in the best interest of the client at all times. Now, does that mean that every fiduciary is going to even do that? No. But a certified financial planner is held to a higher standard of ethics and a board of ethics and ongoing continuing education, and they are held to a higher standard of fee transparency. So I want to focus on that because if you're working with an insurance broker, they're oftentimes not fiduciaries.
So now, this is not a question, it's a comment from, I'll keep it anonymous. I once had an insurance agent tell me that insurance companies are not in the business to provide a service, but rather in business to make money. I think that, and look, we're not dissing insurance.
And insurance is a key component of many people's plans. So this is not a negative on insurance. Oftentimes insurance and annuities very much have their place in a client's portfolio. They're not a one size fits all solution. Not every client needs one. Some clients do, but it's the problem when you're getting it from an insurance broker that is only insurance licensed is when you have an inherent conflict.
I would say, Christina, if you're 30 and you're buying term life insurance, that's one thing.
That's fine. Yeah.
But when it comes to plunking down, premiums that have big zeros behind them, you really should, as Christina is saying, seek out a certified financial planner, because that individual, and Christina is a certified financial planner, but that individual can kind of take a holistic approach and help in the decision-making process. Is this one element? Does this make sense when given the totality of the circumstances? And something else that's important to highlight is only people who are insurance licensed can sell insurance. Only people who are securities licensed can sell securities, stocks, okay, and tax-free bonds. So it may be that the insurance agent, they're not necessarily a bad person, but they're not even licensed to sell that other stuff or to talk about it. So that's why a certified financial planner has a different designation, and they take kind of the bird's eye view, the 30,000 foot view.
And with the certified financial planner, what I will say is you could be a certified financial planner and have that designation, but you could also be an employee of a certified financial planner that's an employee of a major life insurance company. And again, that's where you could be a fiduciary. You're required to do what's in the best interest of the client, but you're still limited with the products that you have. And so that's where I just say, make sure that you're working with a certified financial planner that is a fiduciary, but that's also not beholden as an employee to a company where they're limited in what they can offer you.
Yeah, well, that kind of poses a conflict of interest, doesn't it? If you're employed by a company and their marching orders are sell what is on our shelves, which is it's a rational business call. But if all they can do is sell what's on their shelves, something that's not on their shelf might be more appropriate and in the best interest of the client. So that's, I don't envy people who have to seek out a financial advisor. This is a really tough, and I've said this in other contexts, but the most important decisions in life are not what and when, but who. Who do you marry? I would say that's a pretty important decision. You know, who is your financial advisor? Equally, not necessarily is up there with marriage, but my point is the who decisions in life are very difficult. And I will tell you, Christina, many of our clients, just to give some context, as you know, many of our clients are getting old. I mean, we're all getting older, but many of them have retired or been retired or recently retired, and their advisors are retiring. So they might have known someone for 10 or 20 or 30 years, and that person's retiring. And sometimes people just close up shop, right? Or they might sell their practice or transfer their practice to a different person. And you go, yeah, I mean, I have socks older than that person, or whatever, you know, the objection is. But my point is, many times people, you know, when you do reach these retirement years, you have to find a new team. You have to find new advisors, and it's daunting. So.
Yeah, so this is really just a summary, and then we'll kind of get into a couple more nuance slides here. But, you know, commission only, you know, could be a fiduciary. Oftentimes they're not. Very limited typically in services. The hybrid model is probably the most common when you have an independent advisor. Is they do comprehensive financial management. They typically have a wider array of investment options, choices. They could choose to do a particular section of the portfolio commission only because that's in the best interest. They could do certain things on a fee basis. They could do a retainer. So hybrid gives the advisor the flexibility to truly do what's in the best interest of the client. And then fee only does have a high level fee transparency because it's just one fee. But they do sometimes have limited solutions, and it might be something that really shouldn't need a fee assessed to it. So I'd say the hybrid is probably the most common for fiduciary advisors that are out there.
So it's important to know, advisors, there's a fork in the road. If you're an advisor and you're helping people with their assets, you're either a fiduciary or you're not, right? And so you've chosen to be a fiduciary. And remember, a fiduciary comes from Latin fides, which is fidelity. They have to be faithful to their client and put the interests of the client above their own interests. And then Amy asks, what is the best way to find a certified financial planner?
So you can, obviously, we certainly are. We'd love to have a chance to talk to you, but we do have a team. We're a certified financial planner only office with Ascent Wealth Management. And so we do have 4 CFPs on staff. However, you can also go to the CFP board and the CFP board's website, and you can search for a CFP in your area. And again, I would look for one that is not an employee, but that is an independent advisor. And kind of going to the next slide is who's who. There's a lot of information in this sector, and I always love the questions I get from clients is, why is there so much paperwork? And it's because there's so much regulation in this industry. It's not that they enjoy killing trees. They're slowly moving to paperless as best they can, but the regulators, there's a lot of different entities in this space. So a broker dealer could also be a registered investment advisor. So there is a broker dealer is where people that hold a securities license for certain things that are commissionable products. That could be an annuity, it could be mutual funds, but any of the FINRA licenses are held with a broker dealer, just like a realtor would hold their real estate license with a brokerage firm, whether it be Century 21 or Keller Williams. So a lot of financial planners will hold their securities licenses with a broker dealer. Now, they could be a wirehouse, they could be an Edward Jones, it could be a Wells Fargo, it could be a Morgan Stanley. They are broker dealers. That's where you hold your license. But there are also independent broker dealers. Ours happens to be Cambridge Investment Research, and you hold your license with a broker dealer. They oversee all of the compliance aspects and suitability of the client to make sure that licensed registered representative is doing what's in the best interest of the client. They are overseeing things for anti-money laundering. They're doing all the compliance back office. making sure people are appropriately registered in a state if they're selling securities in that state. Registered investment advisors are the compliance oversight and regulatory body that oversees that is the SEC. So you have FINRA overseeing broker dealers, you have registered investment advisors overseen by SEC, and those are all state registrations. Registered investment advisors are a registered investment advisory firm allows for fee basis or flat fee or assets under management. So you cannot charge anything on a fee basis if you don't have a registered investment advisory firm. And some broker dealers do both. So sometimes, Edward Jones, that could be a registered investment advisory firm and your broker dealer. And then sometimes independent advisors may also have the same firm do both, but sometimes they have their own registered investment advisory firm and they have the broker dealer to hold their securities licenses. So it's quite confusing, but I would just say that that's kind of a breakdown of the who's who. It's different compliance bodies that are overseeing.
So would you say the broker dealer registered or is supervised by FINRA, that tends to deal with the products being offered, and then the registered investment advisor that's regulated by the SEC, does that tend to regulate the person who's doing the selling typically? Or, is there that kind of a division?
No, because it's still monitoring the trading activity. So for example, if I were to go buy Apple shares in my personal account and then also buy it on behalf of clients' accounts that I have discretion to trade their accounts in a fee-based account, if I were to front run or give myself a better price on the share for that day, the compliance oversight from the registered investment advisory firm is going to flag that and say, even though you can do things on a fee basis, you've got discretion to trade in your accounts, you front ran your account. So there's,
and what that means for everyone else's benefit is if a broker sees a good deal, they get the good deal and give the less good deal to their client. That's front running.
Yeah.
So if I'm a registered, let's say I'm a consumer, like the 60-year-old consumer out there in the ether. I've got a $1 million IRA. I got $1 million invested, and I go, oh, I really like this person. I met this person who wants to be my advisor. What sort of due diligence can I do on this person? Where do I go on the internet other than Googling the person's name and maybe checking their Facebook page out? What are some resources I can go to get a quick check to see if this person's a crook or not?
That's a great question. So if you have a securities license, the first place I would go is finra.org broker check. And so if you go to finra.org and then you go to broker check, you can look up that broker or that advisor. They could still be an advisor, and they would have any securities licenses. Sometimes people have become an advisor and dropped their securities licenses because they don't like their track record on FINRA. So even if they're just an advisor and they do things on a fee only basis, they could have had securities licenses before. And you just want to get a feel for what their historical track record is, because any lawsuit, complaints, those will all show if there's been any disciplinary actions, bankruptcies, foreclosures. Those are going to be a public record for that financial advisor. And a lot of times people just don't even look them up, and they're out there, and it will show their education. Do they have a degree? What certifications do they hold? What licenses do they hold? What states are they registered in? All of that's public information on finra.org, and go to broker check.
FINRA, FINRA.
Mm-hmm.
What does that stand for, FINRA?
The Financial Industry Regulatory Authority. And so then you also have the CFP board that you can also look at someone's registration. So, kind of want to highlight for the next topic is I just want to dig into the wirehouses just a moment, and, really where the conflict lies. And that's really where some wirehouses have proprietary funds. And this could be Vanguard. I mean, if you look at some clients that go, I like Vanguard, I can do it myself. Well, what do you typically have if you have a Vanguard account and you're not doing all your own trading? You're kind of relying on some of their recommendations. It's proprietary funds. If you have a Vanguard account, you're going to have Vanguard mutual funds. If you have a Fidelity account, you're going to have Fidelity mutual funds. And that's how those fund companies get paid, is they're getting money on the back end and in the internal fees of those funds. Doesn't matter if they're low cost, they're getting more funds, they're getting fees. And it doesn't always mean that that's the best fund for its asset class. And so, if you have a Vanguard California tax-free fund, that could significantly underperform a Lord Abbett fund or a Franklin Templeton fund. And so you just want to make sure that what you're getting is the best. And sometimes there's inherent conflicts of interest there. The other thing would be cross-selling packaged products. And those could be a packaged product such as an annuity. And certain carriers or product companies will pay more revenue share to the broker dealer or the wirehouse. And I'm just going to pick on Edward Jones for a moment, just because I used to work there. And it was eye-opening when I was at a education event for educating other financial advisors, which was in my former corporate career. And the wholesaler basically said, you can't talk about this product with the Edward Jones advisors because we don't pay that much to the client, because we're not willing to pay as much revenue share to Edward Jones to have the shelf space on their product list. And so it's really eye-opening when you have certain products that pay more to the client in the open independent world versus at a wirehouse. And it's just goes back to the revenue sharing to those firms. And that's really where there's no fee transparency. And it kind of goes to the whole grocery store. When you look at the grocery store, you got the end product shelf, and then those products pay more to have that end cap space so that you see it when you're in checkout. That's the same thing with certain products in the big bank space. It just is. And there's more limiting products there. I think, Fidelity might have 5 annuities or so that they can offer. They don't have the full breadth of the industry that they can offer. So you just want to make sure that you're truly getting independent advice. And it's not to say that those firms do a bad job. They do a really good job for, 60% oftentimes of what a client needs, but there's sometimes things that they're limited in. And then the other thing I mentioned here is trust administration limitations. And Jim and I have dealt with this with clients, and not having things properly funded in a trust, properly titled. Oftentimes for certain clients, we'll use IRA trusts if it warrants. If their estate plan really needs an IRA trust, you have to make sure that that firm and that custodian, that's custodying your assets. So if your IRA is held with Vanguard or, TD Ameritrade or Charles Schwab, wherever it is, you need to make sure that your advisor and the custodian knows how to administer that type of a trust. And we've run into issues with some big firms that don't know how to properly administer those trusts.
So Donna asks, in order to research FINRA.org, didn't you say a person needs a broker's license? But what about the average person? Any other resources other than the CFP board or website? So FINRA, anyone can do broker check. By the way, you can do the same thing with a lawyer in California. You can go to the California State Bar and look up a lawyer by name. And the State Bar of California has something similar to FINRA, which is, it says what if you're a certified specialist or not. It also says if you've had the State Bar take action against you. Okay, so that's a real important thing. But no, you do not have to be a broker. You just go to FINRA.org. I think it's a big blue button you hit, because I do broker check probably 5 times a week, just interacting with clients and their advisors just to check their advisor out. But there's the CFP board. What other resources might there be, Christina, for Donna or for anyone?
You could look at, the 5-star wealth management, awards, and, those that are 5-star wealth advisors in the area. So 5-star, in order to have a 5-star wealth management award, you have to have certain assets under management, certain years of experience, no customer complaints. You have to have had a good amount, of referrals. They check on your clients to make sure that you're referral worthy. So I would just say that there's various sources out there, but even if you don't currently hold a securities license, if you previously did, FINRA is probably a great place to start, because it'll show, did that person, are they running from something, or did they have a lot of customer complaints? And if they don't have a broker's license, then I would start with the CFP board from there first.
Is it so Anonymous asks, is it recommended to have a financial planner in the same state as your residence? Now, I would say this caveat. I'm assuming that you live in the United States, because if you don't live in the United States, it's a different set of rules. If it's the same state as your residence, I don't think that's necessarily required. And then I'm going to give you my thoughts, and then Christine, I'll ask for your input. But there are a couple of things. Number one, we're in California. California, at least for the moment, has the highest income tax, highest state and local income tax. I think New York is trying to raise theirs, which might, if you live or work in New York City, or your spouse lives or works in New York City, that subjects your income to additional local taxes. My only concern would be, I would be hopeful that if payment of state income tax is an issue for you, that your financial advisor know that, if you're living in California, that there's a high California tax. If you hire an advisor in Texas, is that a showstopper? No, but there's no state income tax in Texas. So when they model things out, they need to be mindful that you're subject to that state income tax. You want to talk about licensing, Christina? I mean, if you have a client.
Yeah. So, I think you kind of hit the nail on the head. If you're in California, I think that it's important that you have an advisor that understands California's complexities and high tax environment. And, a perfect example would be Prop 19. If you have an advisor, I can't tell you how many clients I was able to help that were in the process of inheriting or potentially inheriting property, that we were able to be knowledgeable about Prop 19. An advisor that's in another state that handles a California resident isn't going to probably be up to speed on those things. And so I do think that there's a more complex problem for high tax states that gives California advisors that are up to speed on all the tax planning strategies for California is going to be able to best help a California resident. Now, that being said, we have a lot of clients. We're registered in almost every state, but for our registered investment advisory firm, we're registered in almost every state. And we have a lot of clients that will retire in Nevada, Idaho, Texas, and Arizona, Washington, more Tennessee, more tax friendly states for retirement. And that's part of our planning techniques, is we planned for what they're going to do with their assets in retirement, what tax rates they're going to be at. And it's not difficult for us to work with a lot of clients in other states, but I think it is more difficult for others, advisors that are out of California, dealing with the complexities of California, because I think California is probably as complex as it gets next to New Jersey and New York. So it is critical having an advisor that can understand those needs.
Yeah. And I'll tell you, I'm just thinking of a fairly common situation. If, let's say, a family has a legacy property in an LLC, a limited liability company, and they say, you know what, we each own a quarter. We want to go our separate ways. We're tired of dealing with this. We want to do a tax deferred exchange and buy another piece of property. Well, in California, if you remove that property from the LLC and immediately, or in the same tax year, do a 1031 exchange, which is a sale of a property, and you buy another replacement property, and you defer federal and state tax, California does not like that. And many times they'll say, then it's called a drop and swap. They'll say, nope, you can't drop and swap. You might be able to 1031 your federal gain, but we're going to nail you on California. So
there's a lot of nuances,
a lot of little quirky stuff. And that's why it's important, not so much the location of the advisor, but if you're a California resident, the franchise tax board thinks that your money is theirs. Okay. That's the taxing agency in California. And there are a lot of rules that you need to know about. And I will tell you, because I talk to people in other states, other lawyers, other tax lawyers, they say, Jim, California is nuts. I mean, you guys are crazy what you do over there. So,
yeah. And I think that, we'll kind of move along here for the sake of time in just a moment, but I did want to mention too, it's one thing to plan for, part of why we run a large tax-free municipal bond business is because The clients that are in California that are in the highest tax bracket are in a 53%, tax bracket. And so having a 4%, tax-free bond, which is hard to get these days, but even a 3%, that's really a tax equivalent yield of 6%. Now, if that client moves to Texas, they can keep their California bonds because California has a lot more of a market for their municipal bonds than Texas. And Texas has no state income tax. So they're not going to tax your California income in Texas. So, there's a lot of different nuances. If you move out of the state, it's a lot easier, but dealing with California residents is very complex.
But if you move to Arizona, at least for now, has a state income tax.
They do. And that's one of the things too, is, I've got a lot of clients in Arizona. I lived in Arizona for 6 years and I understand Arizona's taxation, and it just became unfavorable for some current business owners that are above a certain tax threshold. It's now in the 6.8% bracket as opposed to in the 4. So it's a lot less attractive, but it's still decent for retirees that are going to be under a certain income threshold. But those are planning techniques that need to be looked at as your overall plan.
So John asks, for a conservative retired investor, I'm assuming that means you're financially conservative. For a conservative retired investor who tends to hold investments long-term, is having a CFP on an hourly basis a practical, effective approach?
Probably a flat fee or a retainer of some sort. Typically, there's more involved than hourly. Hourly consulting is typically more for business owners or tax planning. It's very rare that an advisor will do things on an hourly basis for a retiree, but maybe an annual fee or flat fee.
Yeah, so I guess that would get to that is not quite an hourly fee, but because we have clients that do that, right? We have clients that will pay money. They'll say, look, I just want to make sure. They'll hire you, Christina, and they'll say, I just want to model out, okay, how much can I spend? Am I going to outlive my money? What if I have, if I get sick, what happens, and that's where you need to sit with a professional. Because I'll tell you, I was thinking, in getting ready for this, I was thinking about my grandparents, and my grandfather was born in 1909 and he worked at General Motors, and he was a factory worker. He was a tool and die maker. And when he retired, he had a great pension, and they had a little savings, but they were living off the pension. A lot of people don't have that anymore. So
right.
You just have a lump of money. You're like, okay, I got to invest this. I got to deal with this. I don't even know how much I can spend, right? What if the market goes down 20% and I can't sleep at night? And all these things, this is the reason, this is essentially the case for getting an advisor, like a real advisor.
Well, and you brought up a point too, like in the question from the audience too, is just, if you have kind of a buy and hold conservative retiree, that could be what your mindset is, or what you've been told is advisable. It may be that there's other complexities that need to be looked at. Like, you could have an estate that's very quickly going to be outside the subject to an estate tax if the laws change. So what kind of proactive planning is your advisor doing that's beyond just looking and narrowly focused at your investments, that, hey, you're just a buy and hold? I like to tell people the investments, honestly, is probably the easiest component of what we do as a planner. If you're dealing with a broker, they're focused on selling the investments. If you're dealing with an insurance person, they're focused on selling a product. So they're narrowly focused on the product or the solution, not looking at the bigger overall plan. And that's really where you may think, okay, I just need this. I only want to pay for this, but you might be missing, okay, you're going to now have a major gap in your plan for your spouse. If you were to die and lose half your pension, you're not going to have enough assets left over, or you might have an estate tax problem. And so that's really where, if you're only focused on the investments and what you're paying for the investments, you're missing the bigger picture as to what that advisor could be bringing value to the table for what your greater needs are. And so I'm focusing on the investments back here for a second, just because this is an area that sometimes, being in a commissionable account, if you are a buy and hold investor, this could be, something that's of benefit to you, is to just own some mutual funds and hold them for the long term. That doesn't necessarily mean that you're not able to swap the funds. And so what I mean by that is, you could have mutual funds that you have a fund company and you own just American funds or just Franklin Templeton funds. And things can be done in a brokerage account, done on a commissionable basis. You could own A shares, you could own C shares. Typically, if you're in a fee-based account, you're owning institutional shares or advisory shares. So I'm not going to talk about that because that's done on a fee basis. But I want to focus on this for a moment, because when you do have a brokerage account, you're going to typically own A shares or C shares. And a C share is where you pay 1% a year in the internal fee of the mutual fund. So the advisor is getting paid 1% a year. On top of that, the mutual fund managers are getting paid their fund fee to manage those funds, the stocks.
How much is that typically?
It can vary. It just really depends. And what I will say here is that I think that there's been a lot of misleading propaganda and media effort to show that the lowest fees is most important. And I will say academic research shows us that fees are important, but they're not the most important things. If you're sacrificing risk-adjusted returns for the sake of fees, you've got a problem.
What do you mean by risk-adjusted risk?
So we've done some comparisons. I'll pick on Vanguard for a second. We did a comparison of a Vanguard portfolio recently. Clients gone, I've done Vanguard funds. They've done well for me. And yeah, they've done well. Not to say that they haven't, but on a risk adjusted basis, meaning if we were to look at a rolling period of time on a 1, 3, 5, 7, 10-year basis, the average rate of return was 12, but the standard deviation, which is a measure of risk, meaning their volatility 68% of the time, was a 17, that they could be 17% above that, or they could have, a drawdown exposure in their portfolio could be down 17%. That means that they're taking more volatility than they need to get that 12% return. So we did a comparison. We showed, hey, we're not only improving your performance net of all fees, but we're lowering your standard deviation by 3 or 4 or 5. So your standard deviation over here is 17 with Vanguard getting an average rate of return of 12. Your return over here is, could be 12, could be 13, but your standard deviation's 15 or 14 or 12. So are you taking the appropriate level of risk to get the returns you're getting? And that is sometimes a lot of things people don't look at. Was your portfolio in March of 2020, was your portfolio down 30 or was it down 20? And that's important. How smooth of a ride is your portfolio? And is it giving you anxiety that is unnecessary level of volatility for the risk you're taking? And so I wanted to just kind of pick on Morgan Stanley for a moment, because I'd say that they're the highest offender here. When it comes to C shares, they have a lot of clients. I saw a client that I've seen this on multiple occasions, which is why I'm picking on them. And they will have client funds. They'll have a client in a brokerage account, not a fee-based account. They're getting paid commissions to be in mutual funds, which they were good mutual funds. But they were multiple fund families. They had a Franklin Templeton, they had an American Funds, a JP Morgan, and they had significant dollars, over millions of dollars with in C shares, which means the advisor is getting paid 1% a year. And that was good for the advisor, but the client was holding those long term. An A share means that the client pays a higher upfront fee to obtain those funds, and then they have essentially a very minimal 12B1 fee, 0.25 on an ongoing basis. And 12B1 fees, there's nothing wrong with them. If you're going to be a buy and hold investor and invest in mutual funds, it's more advantageous for the client to pay a little bit more upfront to pay a lot less in the long run. So I want to highlight that on the next slide here, which just gives an example. This is a very standard, typical mutual fund company. If you're going to have an A share, if you are doing very small amounts, you're paying a higher upfront fee.
5.75% on 20. If you have 20,000, you're paying. Now, do they take that out of your account, or does it just come out of your return? How do they take that?
It comes out of the return initially. So, that is a very high fee. So typically that would make sense to do a C share. It's, especially if you're going to hold it short term. Mm-hmm. But then you get into that point where you're like, okay, 250,000 or more with, mutual funds in your account, it makes sense to be with one fund company and get that break point to where you're paying 2.5% one time. And then you're paying very little on an ongoing basis, and your internal expense ratio. So you're paying 0.25 to the advisor on an ongoing basis on an A share. On a C share, you're paying 1%. the internal expense ratio on a C share is 1.39 that's being charged every year. The internal expense ratio on an A share is 0.64. And here's a highlighted example of if you had someone that's investing 10,000 on the initial investment, an A share versus a C share. C share is better for a long time. But if you've got A share, you're going to, I mean, year 4 is your break even on a $250,000 investment. So this just kind of goes to show that, you know, a wise man pays a lot once, a fool pays a little often. And you just need to be looking at those things. And is your advisor doing what's in the best interest for you?
So
A shares are not bad. C shares are not bad. It's when they're used inappropriately that it's bad.
So would you say the C share would be considered a no load mutual fund?
No, it's still got, I mean, it's still got a load in it. It's just paying.
So what does it mean when you see it on a TV commercial? You see some companies say, "Oh, we only sell no load mutual funds. You know, go here to buy a no load mutual fund."
Yeah.
Are they charging anything for the investments? And if they are, how much are they charging?
They're charging it in the expense ratio of the fund. So it just means that you're not paying an upfront fee to obtain that fund, but then sometimes you're getting far, you know, inferior performance. So, and oftentimes if I'll compare an American funds to a Vanguard fund, the no load mutual fund with Vanguard gets over a 10-year period of time, 2% less per year annualized rate of return with more volatility than the load fund with American funds. So it kind of goes back to that saying of, again, are fees important? Yes, fees are important. How are you being charged these fees? Is this the best fund for this type of risk exposure? If you're looking for a large cap growth fund, what's the best large cap growth fund manager? It may not be the no load Vanguard fund. Are they getting good returns? Sure. On a long period of time, are they getting the best returns? Would you have been better off paying a small load? Probably.
Let's talk about deductibility.
That is probably the most important component of how the fees are being charged. And I know we'll wrap up with this, but I would just say, again, fiduciary fees are deductible. Advisory fees are not. And a fiduciary fee can be charged to a trust that files a 1041. A fiduciary fee can be charged on a retainer basis, on a flat fee basis. It can also be charged as an asset-based fee to the account in certain fashions. So what I'll also do for a lot of my business owner clients, you know, their business expenses are tax deductible. I'll do an analysis of their corporate plan, whether they have a defined benefit plan, cash balance plan. Do they have a 401k plan that's the, you know, what's going to give them good employee retention, but also good business owner tax deductibility? We can charge that fee to the business so it's tax deductible. And so it's where you charge the fee, how you charge the fee. You know, should we have more of those fees because maybe you have more IRAs than non-qualified assets, after-tax assets. Maybe we charge an advisory-based fee to the IRA because it's pre-tax, and we charge less of a fee to the non-qualified assets because you can't deduct it. So how you're being charged is important. Is it most tax efficient? And is it, you know, deductible to you?
Yeah, I mean, it's great because these are the rules that just changed a few years ago, right? About deductibility of fees, and that was one of the things that kind of went away to a great extent with the Tax Cuts and Jobs Act of 2017, that Trump Act. So, well, do you need an advisor or should you do it yourself? What do you think? I don't know.
It depends.
The other thing I got to say, and I've been helping older people for many, many years, you know, cognitive decline is a fact. And, you know, the world is just getting more complex and you know, I think that's a gut check for the individual. Like, do I feel comfortable driving this ship myself, right? Driving the investment ship yourself, or do you need some help? The other thing too is many times a spouse is fully capable, and then that spouse dies, and then there's a surviving spouse, and the survivor comes in and they say, I haven't even written a check in 30 years. I don't even know what to do. So just some mindfulness on that, I think is good advice. Go ahead, subscribe to our YouTube page. If you're watching this on YouTube, or if you're watching it live, go ahead and make sure you subscribe. If you'd like to reach out to us at Cunningham Legal, you can go to our website, CunninghamLegal.com. Just type in Cunningham Legal and it will pop up. You can request an appointment with a lawyer if you would like to go over your estate plan. For financial side, the financial side of it, please reach out to Ascent Wealth Management. There's their number, their main office in Westlake Village. They have offices in Southern California and Northern California, and they represent a lot of our clients, help out a lot of Cunningham Legal clients. So we have another question. Thank you. Great. Lola, thanks for that. Any last questions, and we'll wrap it up. I want to thank you, Christina. This is very helpful because this is a really cryptic world, sort of another world of financial advisory fees and how that whole thing works. So if we don't have any other questions, I think that's it for us. Thank you, Christina, and thank you for attending and watching today. Bye-bye.
Thanks, everyone.